This is Kahlil Adam, head investor for Itaú Private Bank's offshore operations, and thank you for tuning in to our International Market Monthly Update. International market action was dominated by two topics which have been increasingly scrutinized by investors. The first is the U.S. debt ceiling and risks surrounding the U.S. Treasury potentially missing some payment obligations. While there are numerous outcomes being discussed, our base case is that Democrats and Republicans will come together and reach an agreement in time to avoid a historic default. The second topic continues to be the Fed and the U.S. inflation outlook. The Fed raised rates another 25 basis points in May, and market participants are now focused on the June meeting. The current consensus call is for the Fed to pause and not raise rates in June, although the expectation for rate cuts have been pushed back into the future. The fixed income market has reacted with the 10-year Treasury yield rising 30 basis points this month to 3.70% at the time of this recording, and a small correction in the investment grade index of just under 2% loss month to date. As for the global economy, we continue to find indications that it is slowing despite low levels of unemployment in the U.S. We've seen PMIs, which indicate manufacturing activity, weaken into recessionary territory. Housing remains weak in the U.S. and in developed markets, and banks, especially smaller banks, have struggled with rapid rate hikes, which result in tighter lending standards. Ultimately, the combination above of higher interest rates for longer, labor cost pressures as unemployment remains low, and weaker leading indicators result in a weaker outlook for corporate earnings. Consensus has revised down the outlook for the S&P 500 earnings per share from a peak of 230 to 218. Developed market equity indexes have been largely range-bound, with the S&P oscillating between 3,800 and 4,200 points. And given we are at the top of this range, caution is building, given the majority of the recent outperformances come from a handful of large-cap tech companies. Small-cap companies tend to reflect the domestic economy and are down 30% from their peaks, while Apple's market cap is now larger than the entire Russell 2000 small-cap index. In fact, Apple and Microsoft represent approximately 14% of the S&P 500 index, and excluding the performance of these two stocks will eliminate 60% of the S&P 500's year-to-date outperformance. Net-net, we will continue to monitor the debt ceiling negotiations and global inflation numbers to get some indication of when we will get a definitive direction for the international markets. In the meantime, if you have any questions, please reach out to your banker or investor for our updated views. Thank you for joining us, and see you next month.